Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Very quickly before I get into today's episode, just a quick reminder, my new book, Wealth by Design, if you want to learn more and register for pre-orders, just listen in at the end of today's episode. I'll tell you how to do that. Okay, let's get into today's episode, which is really about the hidden incentives behind recommending either property or shares. Now, there's conflicts of interest really throughout the Australian financial services industry, and it's important to be aware of them. A conflict of interest, of course, does not mean it's always going to result in dishonest advice or even incorrect advice. So it doesn't necessarily automatically equate to that. But I think in a situation where there is a conflict of interest or a potential conflict of interest, you, the end person, the receiver of the advice, the person that's going to live with the consequences of the advice, are probably better off to know that so you can kind of navigate that. You're better off to know it than not know it, of course. So what I wanted to do today in today's episode is just talk through, some of the observations, experiences and so forth that will help you kind of identify these sorts of situations and hopefully help you give greater confidence on the advice that you're receiving from different professionals that you might come across. So the first thing is, the financial incentive. There's a famous American author called Upton Sinclair, and he famously wrote in one of his books, "It's difficult to get a man to understand something when his salary depends on him not understanding it." So this is a little bit more distinct from, financial incentives in terms of commissions or bonuses or these sorts of things. Of course, that creates a huge conflict of interest when getting advice. But if I'm employed in a certain industry and that's how I make my money and I work in that industry for many, many years, I will convince myself that what I'm doing and what I'm selling and what I'm suggesting is really the best way to go about it. Now, again, this is not about being deliberately deceptive or dishonest or, having a deliberate bias. It's just the reality of a situation that, typically if you speak to people in the property industry and that have been in the property industry for many, many years, every single day they're talking and thinking about property. So their data set is skewed already towards one particular asset class, and they probably comparatively would spend maybe 1% of their time thinking about the other major growth asset class being shares. But also what you'll find is that they eat their own cooking as well, as in that's where they've tended to build their own wealth. So again, people in the property industry are more likely to generate personal wealth using property rather than using shares. Plus also, if they're doing a really good job, their data set is, a whole bunch of clients that have also built a lot of wealth in property. So it's kind of circular, if you like. I need to believe in this to get paid, or maybe I believe in it and that's why I've been attracted to the industry and I want to work in it. I'm going to help clients buy great property and that'll see them generate wealth. Because I see them generate wealth, I'm going to do the same or take the same approach for me as well. And it's kind of a sort of circular feedback loop. And it's completely understandable, of course, if that's what their lived experience is, then of course they are going to have, deep conviction with it. And if they don't have any lived experience around share market investing, of course they're not going to have deep conviction. So the practical question here is not really whether the person is being dishonest. Of course, if you think they're being dishonest, you're going to run in the other direction. But it's really how broad is their experience? And how broad do you need their experience to be? Because if you have decided you're going to invest in property, then it's all good because you've made that decision that you're going to go in that direction. Or if you've decided, the way you are going to invest in property is what I talk about in terms of high growth property, then you can find someone that really believes the same that what you believe in, and they'll help you implement that strategy. If that's the case, it's fine. But you know what Warren Buffett says? Don't ask your barber if you need a haircut, because of course they're in the business of giving haircuts. The answer is always going to be yes. So if you ask someone where their lived experience is just or mainly property, then of course their answer is going to be you should invest in property. And here's all the reasons why you should, and here's all the data. And it's hard to argue with, but if you're looking for balanced advice, that's not necessarily the place where you're going to find it. Now I'm going to keep talking about property versus shares because they're the two main asset classes. And also believe that, most people don't need to venture outside of those two main asset classes in order to build a smart low risk strategy that's actually going to help them build substantial wealth and achieve their goals. So that's why I'm talking about property and shares, but a lot of this stuff applies to other asset classes as well. The less obvious situation or conflict here is that property tends to be relatively set and forget, whereas with investing in shares, there's more ongoing work. Now, firstly, I think what I want to do is separate ownership structures from the asset classes, because we might talk about superannuation or investing through a family trust. They're really the ownership structures. What I'm really referring to are the asset classes that sit within those ownership structures. So if you have a lot of complexity across different ownership structures, if you've got companies, trusts, super funds, self-managed super funds, so forth, then regardless of whether you invest in property or shares, it could be because of that complexity you need ongoing advice. But let's put that aside for a second and let's just focus on property and shares regardless of the ownership structure. Now, maybe the best way I can make this point is using a couple of examples. If I meet someone, a prospective client, for instance, that comes to me, has good, strong cash flow, stable employment, maybe they've bought their own home with a mortgage, but they don't really have a lot of investment assets outside of their home. The home's not really an investment asset, but you know what I mean? They might have a small amount of super because they're in their early 30s, but not much else other than that, maybe some shares and that's it. In that situation, I would probably say, look, the next thing you need to do is go and buy an investment property. In fact, probably over the next 5 years, if you bought a couple of investment properties that are high grade, one great one or maybe a couple of great ones, then then you're off to a good start. And obviously, anyone that's been listening to this podcast for any length of time would know that the evidence-based rationale behind that is just basic maths. That if you've got a very low asset base, the key solutions to that is gearing and most of the return in capital growth and very little proportional return in income. And mathematically, that is the fastest way to go from very little assets to a lot more assets. But in that situation, if that's my advice, there's property tends to be pretty set and forget. There's a bit of strategy work, how much, ownership structures, locations, which buyers agents to use, these sorts of things. But once that implementation step has been done, of course, you need to periodically review performance and make sure that it's, growing in line with what the market is doing, that it's performing well, that you're maximizing its cash flow in terms of whether you should make any repairs or improvements to the property, these sorts of things. So I'm not saying it's completely set and forget, but it is largely set and forget. And so in that situation, if those clients are contemplating engaging ongoing financial advice, it's probably likely they don't need it because it's clear what their next step should be. And together with, a great mortgage broker, a great accountant, and maybe a little bit of additional help, to find the right buyer's agent, that team will be enough for them to complete the implementation, typically. By contrast, if I meet a client that is already well established, that maybe shouldn't be, it's not appropriate for them to take on additional gearing, and or they've already got a substantial asset base invested in direct property already, and they've got a strong, investable cash flow, it's likely that the best move for them might be regular share investing, or maybe they've already got, a substantial portfolio of shares. In that situation, ongoing advice is probably more necessary, particularly compared to the first scenario. You've got to manage a portfolio, make regular contributions, you've got to decide what to buy next, how to maintain diversification, which ETFs or managed funds, index funds to use, how to respond to changes in markets and goals, taxation considerations, all those sorts of things go into the mix. So there's a greater need for that ongoing service. And that's why even for an asset class agnostic practice like ours, there's still an inherent conflict of interest here because the asset class you recommend can influence whether that person is going to need ongoing advice. And if you're in the business like us of providing ongoing advice, then, that's kind of where you need to head. Now, again, just because a conflict of interest exists doesn't mean that it's going to color the advice or the advice is going to be wrong, because quite often we meet people very regularly. In fact, we meet people and we say, no, like go and do this and then come back in a couple of years' time. So I'm confident it doesn't impact the honesty of the advice, but it is still very important to set out for people that aren't necessarily in the industry to sort of understand how these conflicts exist so that they're just aware of them and they can be more mindful of them. The next thing isn't a conflict, but really a bias, and it's called familiarity bias. So if you're familiar with a particular way of doing things, you use it as kind of a mental shortcut. You always sort of divert to it. And so, I mean, I've interviewed a lot of financial advisors, prospective team members, new team members, and there's not a lot of working knowledge of how we use residential property in an overall strategy. And so when I ask, how do you incorporate property into your strategies or into your advice, I will usually either get a completely incoherent answer or sometimes a very honest answer is we don't. And at best, the answer will be it's a client-driven decision, as in the client needs to ask about it, the client needs to direct it, say, I want to invest in property, and then they will incorporate it. And so that's always a concern and certainly a reflection, an unfortunate reflection of where the financial planning industry is currently at. Now, I'm not sitting here suggesting or arguing that everyone should invest in property. Of course, that's stupid. In fact, I'm completely agnostic around property versus shares. I don't really care. I mean, it makes no difference to me. Whatever works for you. I would think generally most people are probably going to be well served by having a combination of the two major asset classes in their portfolio. But, it really depends on their individual circumstances. So completely agnostic. So I'm not suggesting everyone should go property. But what I'm suggesting is that if you're going to get advice, you would hope the advisor has equal depth of knowledge and experience in both asset classes. Because then, as an advisor, I can weigh up without any bias of what I think is going to be in your best interest. However, if you're dealing with an advisor where their sole competency or core competency is really around portfolio management, share portfolio management, superannuation, then it shouldn't be surprising that's probably typically going to be their recommendation. As that saying goes, to a man with a hammer, everything looks like a nail. Now, just as a sidebar, still related to today's podcast, but separate to it to some extent. I mean, the reason this imbalance exists is because the financial planning industry was largely based on commissions. Back before 2013, financial planners would sell products, manage funds, and they would earn a commission. That's how they got paid. And so in the late 1990s, the existing regulation's been changed a little bit, but that core of that regulation, that's how it was written. And it was written around an industry or to protect consumers from an industry that was predominantly almost entirely commission-based. And so that's where it really focused on these sorts of products, which is really managed funds. And property really sat outside of that framework. And property's always been regulated by the states, whereas financial services are regulated by the federal government. But that was then, this is now, and it's changed, right? It's all fee for service now. Advisors cannot earn conflicted remuneration. They can't earn commissions. And so I think it's now incumbent on all Australian financial advisors to educate themselves about the evidence-based ways that clients can build wealth through investing in property. Again, I'm not suggesting that every advisor needs to become pro-property, but what I'm saying is that we need to have competency across all asset classes. And that way we can then make a genuine comparison and give advice that reflects the client's needs rather than just the advisor's comfort zone. And when you do, when you look at any of the education that is required in order to become a licensed financial advisor, there's virtually none. In fact, there's none on property. That doesn't cover property at all. So clearly there's a massive bias in the industry, and that can be a problem. And I'm not calling out anything new here. I think most people are kind of familiar with this, but in the context of today's blog, I think it's important to point out. I just wanted to give a little bit of history there. I mean, the good news, I think, is that younger advisors are seeing this and they're keen to learn. They're keen to find and work in firms where they get broader exposure to both these asset classes. Next thing I want to talk about is confirmation bias. Confirmation bias is where you become overconfident just because something has worked. I mean, if I meet someone that's become a multimillionaire by investing in Bitcoin, how am I going to, convince them that Bitcoin's not worth investing? I mean, that would just be stupid, right? I mean, their mindset is going to be, well, look where it's got me. How can I not believe that it's a good investment opportunity? And so confirmation bias really drives people to kind of focus on any information, views, or anything like that that supports their beliefs, their existing beliefs. And as a result, they tend to drown out anything that is contrary to those beliefs. An extension of that then is overconfidence bias, starts attributing the asset classes qualities or their approach or these sorts of things as the reason for the return they've earned the return, as opposed to things like timing, good timing, luck, or favorable market conditions. And so they become overconfident in that asset class or that investment strategy just through their own personal experiences. So again, when dealing with someone that has built wealth in a particular asset class, that's what you need to think, because if you're looking for sort of balanced advice, you're probably not going to get that. You're going to get these biases that are going to play out. Again, if you're looking for balanced advice, then it's probably not the best place to look for. But if you're looking for advice to invest in that particular asset class, then that's great. But just be careful that, you're only ever probably going to receive good news, or you're only ever going to receive information about all the positives. Whereas if we had these biases, you're going to sort of drown out any of those negative signals. Status signaling can also be another way businesses use to sort of market themselves and sort of color advice. So it sounds sexy, go and become a property mogul, go and buy 10 properties over the next 2 years, get yourself out of the rat race. Here's a case study of a client that did that, these sorts of things. Sometimes the advice becomes more about self-image rather than, how to fundamentally come up with a good strategy to build long-term wealth. And that's where it becomes risky, because that's when we're making financial decisions based on ego sometimes rather than fundamentals. The reality is that a great strategy is rarely sexy. In fact, evidence-based approaches tend to be relatively boring. The progress that occurs over the first few years is hard to even measure, but the progress achieved over many decades is extraordinary. So it doesn't need to be sexy, it just needs to work. So there's some of the ways that I believe there's some conflicts of interest in the financial service sector. At least they're the major ones that I sort of tend to come across. I think that 90% of the success in managing these conflicts or biases is really just simply recognizing and understanding they exist. And some of them aren't particularly obvious, which is why I wanted to record today's episode. So once you acknowledge that a potential conflict can exist or a bias can exist, then it's really just about giving yourself permission to, investigate the advice, interrogate it, ask questions, get a really deep understanding so that you're able then to assess whether it's been coloured by any incentives, experiences, bias, conflicts, these sorts of things. Again, just because these things exist doesn't necessarily mean it's going to result in bad advice. Whether it's dishonest or not appropriate for you, you can still get, really good quality advice from someone that does have these biases. And the good news is that I think good advice, the right advice, should always be easy to explain, easy to understand, because it's typically grounded in evidence, basic logic or common sense, or straightforward maths. And in fact, I use the term common sense there, but the late Charlie Munger, which is Warren Buffett's business partner, actually called it uncommon sense, which is exactly what it probably is, because common sense isn't that common anymore. But I think just being aware of these conflicts, biases, and so forth is the key, and they exist everywhere. I mean, some of these exist in our business as well, and I think I know we're completely asset class agnostic, so it just helps you kind of navigate that advice. Okay, still got time to get into some questions today, which is good because I'll get through some. Okay, this question is from Anakin, and he's asked about the benefits of salary sacrificing into super. And he's sort of saying, well, a lot of people say it's great, it's one of the best investments you can make because it's really tax effective and all those sorts of things. And he's done some comparisons and modeled out, salary sacrificing into super versus just putting it in your personal name investing. And what he's modeled is the amount is higher inside super. So the amount is $447,000 versus $334,000. So a difference of $112,000. But he's saying, but if I retire and my net worth's $5 million, then it's only really a 2% difference. It's peanuts. It's not that big a deal. So let me just broadly talk about salary sacrificing into super and speak to some of these numbers. I mean, the first thing is you want to optimize every single tactic that you do. So just comparing one tactic to total net worth, I think would invite you then to not necessarily make the best decisions on a tactic by tactic basis. And you hope then by doing that, by taking that approach, by optimizing every single tactic, whether it's investing in property or investing in a share portfolio outside or salary sacrificing into super, if you optimize each and every one of them, if they're all going to increase your net worth by $100,000, then and you do 5 different things, then that's $500,000. So I don't think comparing it to overall net worth is relevant. I think comparing if I put $10,000 into super or $10,000 into my personal name, just compare the tactic by itself, and that's the best approach. Because otherwise, if your net worth's huge, then you're probably never going to do anything because nothing's really going to move the dial that much. The first thing to think about is the initial tax benefit. So how much income tax can you save? Because superannuation is really just an ownership structure. It's not an investment, it's an ownership structure. And so all we're doing is making an ownership structure decision. Do we keep it in personal names or company or family trust, whatever? Do we keep it outside super or do we put it inside super? Now I know that if I put it inside super today, I'm going to get a tax benefit. And so what is that tax benefit? And so what you need to do then is just compare your marginal tax rate to your superannuation tax rate. So if your adjusted taxable income is less than $250,000, then your super tax rate's only 15%. If your adjusted taxable income's over $250,000, then it's going to be 30%. So that's the super rate. That's the flat rate that you're going to pay on the contributions. What is the saving? Well, the saving is what your marginal tax rate is. So if, for example, you earn between $190,000 and $250,000, then the difference is going to be 47% versus 15%. So there's a huge 32% tax saving there. The tax saving is compelling. However, if your income is between $18,000 and $45,000, then your marginal tax rate is 18%. The tax saving's only 3%. It's probably not worth locking all your money up inside super just for that initial tax benefit. So that's the first thing to think about, is how compelling is that tax benefit? The next thing to think about is, where is the rest of your wealth owned? What ownership structures? What is your current super balance? And what do you expect your super balance to be by the time you want to convert into pension phase? Because as I've spoken about on this podcast many times, it's really about making sure that by the time you get to retirement, that you want your investments owned in a structure that is most tax effective. And of course, we can have at the moment up to $2 million each. So $4 million as a spouses, a family, 2 couples, that is going to be tax-free in retirement. So you're not going to pay any capital gains tax, any income tax on the earnings, those sorts of things. Now, of course, the government could play around with those numbers, but broadly speaking, it's several millions of dollars. So if you're in a situation where you've got a relatively low super balance, most of your wealth is held outside of super, and the tax benefit isn't compelling, you still might do the salary sacrifice because you want to get more money into super. And the best way to do that is obviously gradually move it across, because we've got to navigate the concessional and non-concessional caps, move it into super over that sort of period of time. So what is the answer? Well, the answer isn't that, salary sacrificing into super is the best thing to do. Actually, I should say there's one final point I didn't. It's also about stage of life as well. So, if you're young, say in your early 30s, you've got another 25 to 30 years to contribute into super. It's a very long runway you've got. And it's likely there's heaps of things that you need to do before you start focusing on super, like repaying your home loan, buying your forever home, building wealth outside of super, these sorts of things. So stage of life can have an impact as well. So even though the tax benefits could be compelling and you have relatively low amount inside super, your stage of life might dictate that you don't necessarily focus on salary sacrifice. But I guess it's not black or white either. It's not about maximizing the cap versus doing zero. Maybe it's about doing something but not a lot in that circumstance. So I don't think the answer is that salary sacrifice into super is the best investment anyone could make. I think that's a too broad a conclusion. I think there are substantial merits, there can be substantial merits depending on your situation, and it can be a great strategy to employ. But I think they're the key things to think about: is what are the tax benefits? How important is it to get more money inside super? And what is my stage of life? So, Anakin, thanks for the question and thanks for listening to the podcast. I hope that gives you sort of enough information to sort of form your own view on this. Okay, next question is from a listener that wants to remain anonymous. Situation is mid-50s. They're in a really good situation. The home's worth $3 million with a $1 million mortgage. 2 investment properties, one worth $2 million with no debt, other one worth $650 with $80,000 of debt. So $2.65 million, $80,000 of debt. So they're positive cash flow, both in husband's name. In terms of income, obviously there's the rental income, plus the husband gets 50 grand per year as a director of a company. Wife has a share portfolio of only $6 million and $1.9 million inside super. They essentially live off the wife's share portfolio and the husband's income. However, one of the investment properties isn't carrying any debt, whereas they've got debt on their home loan, so it's topsy-turvy. First question, is there a better way to change the ownership of one of the investment properties so that we can get rid of the $1 million debt against the home? And would I struggle with the banks being not employed to be able to, in order to do this? So it is a bit topsy-turvy. The only way you're going to be able to re-gear, which is the term, re-gear an existing investment property. So in the example, the first investment property was worth $2 million, no debt, is to change the ownership. So you could, for instance, sell 50%. That investment property is 100% owned by the husband. So the husband could sell 50% of that property to the wife, and the wife could go and borrow $1 million to pay the husband for the 50% share. And then the husband could use that $1 million that he's received to repay the home loan. And so in that situation, you would then have a jointly owned investment property worth $2 million with $1 million of debt. But at least that debt is tax deductible. What's the downside? The downside is that the husband's going to crystallize capital gains tax. So whatever 50% of the CGT is, because he sold 50% of the property, you have to pay that in tax. So you'd have to borrow that as well. Secondly, the wife is going to have to pay stamp duty on the 50% transfer as well. So you're also going to have to borrow that. So the answer as to whether you could rejig the debt and make it more tax effective, the answer to that is depends really on what the unrealized capital gains are in those investment properties. But if there's no debt against it, I'm going to assume that they've been owned for a long period of time. And so the capital gains tax is probably cost prohibitive. That is, you'll end up paying, a lot of money to the government. One way you could, you said joint super is 1.9, so I don't know individual balances. Probably can't use carry forward contributions. So sometimes if we've got a client that has less than $500,000 inside super and they haven't used the concessional cap in previous years, we can use it in that year. I'm going to assume you can't really do that, and we can use that to offset the capital gain, of course. I'm going to assume you can't really do that. I think what I'd do in this situation, or consider doing in this situation, is something, that's the benefit of shares, is we can progressively sell down and spread the capital gains tax over many years. So what you might then consider doing is selling, let's say, $200,000 of the wife's share portfolio over the next 5 years and use those proceeds to repay the home loan. At least then you can spread, she's already going to have the investments look like, but I imagine she's already going to have a reasonable amount of investment income. So her tax position's already going to be maybe more significant. And if she's already earning, like if her taxable income's already exceeding $190,000, it probably does, then whether you sell over 5 years or sell in 1 year is not going to move the dial. It's not going to save any CGT. So in that situation, you might actually decide, look, we'll just take the hit. Well, when I say take the hit, it is what it is, right? You're going to have to pay it at some point. And so maybe the only answer is sell the share portfolio, because at least you're still going to pay CGT, but at least you're not going to pay stamp duty, which is what you do if you change the ownership of the property. And at least it might help you clean up the portfolio as well. Maybe there's some shares in there or investments in there that, you relook at and go, oh, I don't really want to hold them anyway. And what you could do, if you want to reintroduce some gearing, is you could repay the home loan and then redraw it. So repay the $1 million, sell the shares, repay the $1 million, redraw it and go buy some more shares. Maybe not in the wife's name, maybe in an entity that's going to give you more flexibility. Or in fact, I think in your situation, you've got a lot of wealth outside super, but not enough wealth inside super. So that's the other thing you want to think about, or this listener should think about, is how you're going to move some of that wealth into super, because you can have 4 million across the two of you and you've only got 1.9 at this stage, and you're 55, so you're only 5 years away from being able to convert that super into a tax-free environment. Thanks for the question. Maybe not the answer you're looking for, but I hope at least it answers your question. Okay, next question I'm to answer is from Sam. Looks like Sam actually submitted in June 25, so we've taken a long time to get back to you, Sam. So apologies for that. We've got a better process now where we've got its own email inbox rather than coming to other people. So it helps us capture all the questions. Anyway, I'll get back to Sam in next week's Q&A episode. And until next week, bye for now. Now, before you go, one last thing. My new book is called Wealth by Design. It's not a reprint of Investopoly. It's a complete and absolute rewrite based on what I've refined over the last 8 years. If you'd like to be notified the day pre-orders open and receive my pre-order bonus, register your email right now at investopoly.com.au/book. The bonus is a Investopoly research assistant. That's an AI tool that's trained on more than 500 of my blogs that I've written over the past decade. So you can ask it a question and it'll take you to the most relevant ideas and framework. And I'll keep feeding it all my future blogs too, so it'll become a tool you can use ongoing. Again, register at investopoly.com.au/book. Thanks for listening. I appreciate your time.